Unlock recession-resistant gains. Discover the fortress stocks primed for growth in turbulent times, securing your portfolio with certainty.
Because you don't pick stocks, you pick companies.
Yeah, but when I was 11, I picked stocks. I had the whole wrong idea. I was interested in watching stocks, and I thought stocks were things that went up and down, and I charted them. I read books on technical analysis. I read Edwards and Mickey. I think that was the classic then. Hundreds of pages. And I read that whole thing over and over again. I read Garfield, Drew, I read everything. And I thought, the first 8 years, I thought the important thing was to predict what a stock would do and predict the stock market. And then I read Ben Graham, that was 19 or 20. And I realized that I was doing it exactly the wrong way. But it didn't hurt that I had that background and everything.
As the economy faces headwinds, with elevated interest rates, inflation concerns, and whispers of an inverted U.S. Treasury yield curve, investors are contemplating the potential onset of a recession in 2024. History tells us that during economic downturns, even the most robust stocks can take a hit. However, there's a silver lining. Drawing from the lessons of the 2008 and 2020 recessions, we've identified 7 stocks that not only weathered the storm, but outperformed the S&P 500. Let's dive straight into the list. Number 1, Walmart Inc. Walmart is doing really well even when people worry about money problems. They've stayed strong during tough times in the past because they sell things people always need at lower prices. Even when things get hard, most people still buy groceries, and Walmart is good at selling those for less. Experts think Walmart is a good choice for investors because it did much better than other big companies during past tough times. They're saying it's smart to buy Walmart stocks because the company is good at dealing with problems and might keep growing.
On a recent lightning round, Jim Cramer said he thinks that the current levels on Walmart is a good start to buy, but he likes Costco's better. This is Walmart on the weekly chart, and the chart suggests the best levels to go long is $4 lower at the resistance support band at $150.
With new technology and making more money from certain things they sell, Walmart could keep growing. So, if someone wants to play it safe with their investments during uncertain times, buying Walmart stocks could be a smart move. Number 2, Abbott Laboratories. Abbott Laboratories, a big healthcare company, is doing well even when the economy is not. They did better than most other big companies in tough times like 2008 and 2020. An expert named Sel Hardy says Abbott is successful because they have many different types of businesses and manage their money well. They're expected to make even more money in 2024, which is good news.
On a recent lightning round, Jim Cramer said Abbott Labs has gotten way too cheap. He says you should buy it. This is the weekly chart, and after bouncing off the support level at $90, look for the price to continue to move higher and test the uptrend line at the $106 level.
Abbott focuses on important healthcare stuff, so even when the economy is bad, they stay strong. People thinking about investing in Abbott can feel good because experts say it's a good idea. They're predicting the stock might go up, especially since the closing price in November was lower than what experts think it could be. Number 3, Synopsys Inc. In the complex world of designing and testing computer chips, Synopsys Inc. stands out as a key player that stays strong even when the economy faces challenges. Analyst Brooks Eidlet points out that Synopsys provides an important platform for engineers, ensuring there's always a need for chip testing and design services, even when the economy isn't doing well. With an impressive 9.9% better performance in 2008 and a remarkable 70% in 2020 compared to the S&P 500, Synopsys has shown it can handle tough times. As the global computer chip industry keeps growing, Synopsys, being the leader in electronic design automation with a 31% share, is well prepared for the future. CFRA's buy rating and a $560 price target show that Synopsys has a lot of potential. Investors looking for stability and growth in the always changing tech world might see Synopsys as a smart choice to add to their investments. Number 4, Accenture PLC. In the ever-changing world of global information technology services, Accenture PLC is seen as a strong and stable choice during uncertain economic times. Looking back, Accenture's diverse consulting and services business not only survived but did well in past economic downturns, doing 29.5% better than the S&P 500 in 2008 and 7.8% in 2020. Analyst Keith Snyder points out the company's impressive record of earning more than others in the industry, showing it can handle big economic uncertainties well. Almost half of Accenture's money comes from North America, and another third comes from Europe. This mix helps the company, giving investors a strong and globally balanced investment. With a strong buy rating and a $341 price target from CFRA, Accenture closed at $332.43 on November 27, suggesting it could grow even more. As the economy keeps changing, Accenture stays a stable choice and a smart investment for careful investors. Number 5. TMobile US Inc. After joining forces with Sprint, TMobile US Inc. is now a strong player in the US wireless market, showing steady growth even when the economy faces challenges. Analyst Keith Snyder thinks T-Mobile will keep growing and gaining more of the market compared to competitors like Verizon and AT&T. The company's ability to generate a lot of extra cash and having a 5G network that's ahead of others by at least a year make it even more appealing. With a strong buy rating and a $175 price target from CFRA, T-Mobile closed at $148.80 on November 27th, hinting at the possibility of more growth. As technology for communication becomes more and more important, T-Mobile looks like a smart choice for investors who want stability and growth, especially during tough economic times. Number 6. Walt Disney Co. Walt Disney Co. is a big entertainment company that's really good at handling tough times like recessions. It did better than a stock market index called the S&P 500 by 8.8% in 2008 and 9% in 2020. Disney has lots of different things it does, like TV networks such as ABC and FX. These have always been valuable. Even in 2020, when things were crazy, more people signed up for Disney's streaming service, Disney+. That shows how flexible Disney can be. Even when their theme parks closed and they couldn't make movies or TV shows like normal, Disney found ways to use all the different things they offer. Some experts say it's a good idea to buy Disney stocks and think they could go up to $105, even though they were at $95.17 in November. Disney is still a big deal in entertainment, and it's good for people who want to invest money because it's both steady and could grow. Whether it's old school TV or the new streaming stuff, Disney knows how to keep people interested, so it's a smart choice for people who want to invest but are worried about how the economy might change. Number 7. Netflix Inc. Finally, in the entertainment world, Netflix is like a surprise champ when money gets tight. When things are tough, people usually spend less on fun stuff, but Netflix keeps going strong. It did way better than a stock market thing called the S&P 500 by 50.8% in 2008 and 50.9% in 2020. How? Well, Netflix gives folks a way to have fun without spending a lot, especially when times are hard. An expert, Kenneth Leon, says, Netflix is doing so well because more people are watching shows and movies on the internet instead of regular TV, and Netflix is the king of that. They keep adding lots of stuff to watch, and it's cheaper than other kinds of entertainment. Some smart folks say it's a good idea to buy Netflix stocks because they might go up to $530, even though they were at $479.17 in November. Netflix seems like it's here for the long run, staying strong even as entertainment changes a lot. As the economic forecast remains uncertain, these 7 recession-resistant stocks offer investors a strategic playbook. Whether it's the stalwart Walmart or the tech innovator Synopsys, each company brings unique strengths to the table. As history teaches us, a well-diversified portfolio with a mix of defensive stocks can help weather the storm and potentially emerge stronger on the other side. If you found this video informative, then don't forget to hit that like button and subscribe to our channel for more amazing content. Thanks for watching, and we will see you in our next video.